Okay, so good morning, everyone. Good morning, good afternoon, good evening, depending on where you are. Thank you for joining us today. It's my great pleasure to introduce our speaker, Professor Majd from the American University of Beirut. I've had the pleasure of collaborating with Majd for some time now, and we have interesting stories to tell, but he will tell the story today. We'll be talking about electricity systems. Thank you very much, Majd, for accepting the invitation, and the floor is yours.
Thank you very much, George, for your invitation, and I'm really happy to be here today in Montreal. So today I will be talking about what happens when the grid is not reliable. So how can we basically look at markets, whether at a decentralized level or at centralized level, and how can investment and planning decisions be made? So just to motivate the topic a bit, looking at some IEA numbers from 2025, we noticed that there are still 733 million people in 2025 that do not have access to electricity. And the vast majority of those people live in sub-Saharan Africa, the rest also in developing Asia. And if we extend the discussion to reliability, and if we look at the number of people who live in places where the electricity is not reliable, so it exists, they have access, but it's not reliable, the numbers in 2020 at least are around 3.5 billion. So that's a huge number. So addressing the topic of electricity unavailability or unreliability is essential for many societies and many countries. Accordingly, the main theme that we will be discussing today is how should households and communities suffering from unavailable or unreliable national supply of electricity satisfy their electricity needs? How would they approach such an issue? And we could basically look at this topic first as the failure, at a national failure first, to provide electricity to those communities and households. And against or in front of this national failure, households could react by themselves and install their own assets, for example, rooftop solar PV, or, which was prevalent at least until recently, rely on some private actors, for example, private diesel generators, which are widely used in parts of the world like Nigeria, Lebanon, Iraq, and some other places. So a private generator would connect a neighborhood or a village and provide electricity when the main grid is not existing or unreliable. Also, we could look at cases where we have some communities that manage to organize themselves in one way or the other and decided to develop some form of hybrid renewable energy system. So it's a decentralized system. It's not connected to the main grid, but it's serving the consumption of the whole community. And these hybrid renewable energy systems consist of dispatchable, polluting, diesel-based or some other fossil fuel generation, in addition to renewable energy technologies like PV and wind and batteries. However, all of these solutions suffer from problems. So if we look at the households, for example, at the household level, if you install your own PV system that is off-grid, you will end up with curtailed energy in some parts of the day because you have more generation that you can actually consume. And in some other parts of the day, you might end up with unreliable supply. Also, if we look at the case where we have these private suppliers of electricity to a neighborhood or to a village, the main issue is the market power associated with that. So these private suppliers are basically filling the gap of a national grid. And when they do that, they do not do it for free. They do it for returns on one hand, and because the state is weak nationally, not naturally, because it's not able to provide electricity, the regulation associated with these private generators is limited. So they profit from that and they exercise excessive profit. Also, they are a major source of pollution. especially if they are placed in dense urban setups. In terms of hybrid renewable energy systems, one of the main issues is the risk of stranded assets. So you can build your hybrid renewable energy system, but you don't know how long will you be needing this hybrid renewable energy system. And if something changes, if a miracle happens and the grid is available, what happens to your assets, basically? So this is an important question to consider. Also, from a state perspective, once the state wants, desires, or is able to reestablish a functioning grid and system in the country, energy system, electricity system in the country, it will have to deal with fragmented systems here and there, and it will have to solve the issue of lack of funds, which is prevailing in these countries that we are talking about. So given this landscape of opportunities and challenges, the talk today will cover some aspects of this and how to deal with these settings. And we will look at the landscape available from different perspectives. So the first perspective is we're actually looking at the perspective of a hybrid renewable energy system. We're trying to see how would a community design or size and install a hybrid renewable energy system when some things are uncertain. So when the state decisions in terms of when to build a reliable grid and connect this community to the reliable grid is uncertain. That's one thing. The timing of this connection is uncertain. And the second thing is, what are the conditions, the interconnection conditions that end up happening once the hybrid renewable energy system is connected to the main grid? So this is one perspective we'll address. The second perspective we'll look into is basically when we are talking about these private generators that control access and supply in a certain village or neighborhood, how would the state, acting as a regulator in this case, as a weak regulator, so they do not have the strong powers to enforce whatever they want, but they have some weak power. Under this weak power, how would they influence the decisions of the private generator in a way to improve the microgrid, improve access or improve affordability in this microgrid? And a third perspective we might be able to touch upon today, depending on time, is if we talk about the state wanting to re-establish a working national grid, how would it deal with that, taking into account whatever is there in terms of distributed assets, especially if we talk about households? So whatever household PVs are installed, how would they benefit from the existence of these household PVs to basically overcome one of the issues they have, which is financing and the availability of funds? So these are three perspectives that I hope I will touch upon in some way or the other today. And I will start without delay with the first one. So we're looking at a hybrid renewable energy system that is being formed or established when the grid conditions, grid timing availability is uncertain and the interconnection conditions are uncertain. So let's maybe discuss a bit what's there in the literature. A lot of the available literature discusses off-grid hybrid renewable energy system planning. And off-grid means that this community is not connected to a main grid at all. And I list here some of the studies available. And the first one is a literature review for what's there. And there is a lot of work on the techno-economic analysis of these kinds of systems. Also on on-grid hybrid renewable energy systems, and in this case, we're talking about an HRAS that is connected to the reliable main grid. So there is a functioning, reliable main grid. And again, it's a matter of determining the techno-economics of these HRAS under these conditions. Recently, some research has been established around on-grid hybrid renewable energy systems, but under unreliable grid. And I list here some examples. For example, some of the studies discussed scheduled blackouts. So if it's systematic, so we have every 3 hours, there is 1 hour cutoff, etc. Some others also included feed-in tariff or feed-in into the grid. So basically, the hybrid renewable energy system can also feed in its electricity to the main grid. Some others approach it from a probabilistic manner to minimize the probability of power loss. Also, some others have very specific applications, for example, university campuses. However, all of this literature assumes that the grid conditions are static. So we know them, we can qualify them, and they are static for the whole planning horizon that we are considering. What we are looking at in this perspective is how to perform off-grid HRS planning, but under the uncertainty of when and how the reliable central grid will arrive and how it will be established. So particularly, how would the reliable grid timing and interconnection conditions affect the HRS plans, and how to plan under such uncertainty? Also, one important element here, and going back to the story of stranded assets, so if we have some assets in the hybrid renewable energy system, and for some reason we want to retire them, can we retire them at a certain value, or is it completely lost, or are they completely lost? And this is an issue of market liquidity. So how liquid is the market for the sale of used assets that still have some value? Okay. So given this perspective, we're mainly talking about three uncertain interconnection conditions. The first one is the timing, T. When will the central grid be available? And it can be never. And the second one is P, which is the price of the central grid electricity. And the third is the FIT, which is the feed-in tariff for the value associated with any electricity that the HRS could feed back into the main grid. Okay? So we're framing the problem around these three uncertain elements. And from an HRS perspective, the objective function could be to minimize the net present costs. So we want to serve the demand in our community at the minimum possible costs, subject to all kinds of constraints related, technical constraints, mainly capacity, operational, and so on. And some of the constraints are related to the grid availability. So we can interact with the grid only when the grid is available. We cannot interact with the grid when the grid is not available. So just to shed further light on the net present cost formulation, we're talking about actually four elements. So we're talking about capital expenditures and operational expenditures related to the installation of the hybrid renewable energy assets, system assets. So CapEx, fixed OpEx, and variable OpEx, fuel OpEx. And then we're talking about retirement value. So wherever we retire, how much value can we generate out of that? Retirement at a certain time or salvage value at the end of the planning horizon. We're talking about some penalties associated with emissions and with lost load if we do not satisfy all the load in the community. And finally, we're talking about grid-related aspects. And here, the first one is PEC, the purchase cost, so the cost of purchasing electricity from the grid. And the second one is the electricity revenue. So if we sell electricity back to the grid, how much revenue can we? So this is the formulation of the NPC. And I stress a bit on the RTR, which is the value of the retired assets. And this is a main element that we would like to address. I will talk about it in the next slide also further. And I know we're talking about uncertain interconnection conditions. However, it's very important first to model the problem deterministically. Assuming we know these uncertain conditions, how would we plan? And this is a deterministic representation. So we know the triplet T, P, and FIT. We know that. And we are here representing the problem over two time periods. So curly Y represents the awareness horizon. So we're aware over years, curly Y. However, we're making decisions and planning over years, curly YS. Okay? And since we know when the grid will be available, so we can easily divide the period curly YS over two sub-periods, an off-grid period and an on-grid period. And our objective is to minimize the net present cost. We are making decisions related to adding capacity A, retiring capacity R, and these decisions are made on yearly basis. We're also running the available equipment or dispatching electricity, and this is D, that is happening on yearly, daily, and hourly level, at the hourly level. And whenever we reach a certain year and we run this deterministic model, we're aware of whatever happened before it. So we know the installed assets that are available and their remaining lifetimes. So this is a deterministic perspective of the problem, and it's essential to be able to complicate it further. So I talked about the revenues associated with retirement. And this is the formula. I will not go through everything, but the main idea here is that the first line is talking about the value associated with retiring generation assets, and the second line is the value associated with retiring storage assets. And for the first part, R represents the amount of assets of type G that are being retired in year Y and that have been installed in year A. So they have been in service for Y minus A years, basically. And this is the unit cost associated with a single unit of this technology at the current year Y. And gamma is evaluation factor, kind of. So how much do we value the existing assets that we have? And based on an existing concept in economics called value in exchange, the idea here is to value an existing asset based on the cost of a new asset that if we want to buy to deliver the same value that is remaining in the retired asset. So we have an asset, we're valuing it if it's retired now based on a new asset that can deliver the same value remaining in the retiring asset. And based on this, we can derive this equation, the ratio here. And this is a ratio of just the P given A, so present worth from an annuity factor with an interest rate of I and a duration. Lambda is the lifetime of the asset, G, how much it lives on by default. And Y minus A is how much it has been used. So lambda G minus Y minus A is the remaining life of the asset. And below is also the annuity factor, but over the whole lifetime of the asset. So this ratio actually represents the value in exchange of an existing asset when it is retired. And to make it more interesting, we're multiplying it by 1 minus disk. And here we're saying that there could be a case where there is a discount on this value. So somebody might prefer a new asset over a used asset that delivers the same value. And the idea here of disk is to allow us to model market liquidity. So when disk is 0, it means that the market is very liquid. And basically, we can use an existing asset that has a certain value and price it according to a new asset that delivers the same value. And when this is 1, it means that the existing asset cannot be sold. It has to be just got rid of without any additional value. Okay? So this is the deterministic setup. The next step is to develop a stochastic setup. And here, this is a static stochastic model. So we're committing to all decisions at the initial phase. And the idea here is that we no longer have a triplet of T, P, Fit that is known with certainty. However, we have scenarios for this triplet of T, P, Fit. And if we have curly C scenarios, each with a probability alpha, we can think of the problem as a minimization of the expected value of net present cost. And here we have a 2-stage stochastic model where this expected value is represented as the investment costs, which are the first level decisions. So basically, addition and retirement of capacity is first level decision happening under uncertainty. And then operational activities, operational decisions are happening after the uncertainty is resolved, and they are different by scenario C. Okay? So this is a stochastic representation of the model. But we're committing to all decisions early on. So the natural progression is to make it more dynamic. And the idea here is to update our decisions based on new information that becomes available. So we're starting with a certain case where we don't know anything, and we're running a stochastic model over all the possible scenarios. And then 1 year later, we might get new information. We update our scenarios, we update our probabilities. And if there is no grid, we're still in the uncertain range. So we run another stochastic model. Or if the grid becomes available, then we move into a deterministic mode where we know everything, and we can run a deterministic mode. So this plugs in the stochastic and deterministic model representations in one big framework and allows us to incorporate all the information available. However, as you can notice easily.
What are the possibilities? You have no grid, and after that you have several scenarios.
Yeah, the scenarios here are if the grid is available in year 1, what are the possible combinations of the other two uncertainties, the price and feed-in tariff? So what would be the price of electricity sold, and what would be the FIT, the feed-in tariff in that setup? So as you notice with this setup, it's nice mathematically, but it's not very nice practically, right? We're having a lot of uncertainties. We have to update probabilities. We have to update scenarios. So keep that in mind. We'll discuss that also in a bit. Okay, so we apply this to a case of a rural case in Lebanon. This is Lebanon. And what we get out of this, we're also considering scenarios that are relevant for the Lebanese context. So for the time of grid availability, we're considering 11 scenarios. So the grid could be available in years 1 to 10 or never. And 3 prices of electricity and 3 FIT rates. And then we're looking at combinations that make sense, not all of them, but most of them between the 3 elements. We're also considering 3 discounts on the sales of retired assets. 0 as the market is very liquid, 100% as the market is not at all present, and 30% somewhere in. And we're considering 4 technologies for the hybrid renewable energy system: PV, wind, diesel, and batteries. So this is just a display for one realization. So this is one realization of the triplet TPFIT. And if we plan deterministically for this realization, so we're planning under certainty, this is the capacity profile. So this is what we end up installing in this hybrid renewable energy system. We're installing some diesel, PV, wind, and batteries. And then at some point, we no longer have diesel. We only have PV. And then we add some wind at some point later. So this is the planning under certainty case. This is planning under static stochastic model. And this is planning with a receding horizon framework that I just described. So these are happening under uncertainty, but when this scenario materializes. Okay, the planning is taking place under uncertainty. However, this scenario is what ends up materializing. So the receding horizon framework adapts. So when the grid becomes available at year 4, we're seeing an adaptation here, similar to the adaptation of the deterministic model. And the dashed lines represent the deviation kind of from the deterministic results. So we can see that the receding horizon is pretty similar to the deterministic planning. And this is for a discount of 0. So the market is very liquid. Now, we can really generalize this because here we're talking about only one realization. So to generalize this, we compute the value of certainty, which is basically the gained value from planning under certainty compared to planning under uncertainty. For the 3 cases, for a deterministic model that is naive, so we plan for a scenario, and that scenario might materialize or not, for a stochastic model, and for the receding horizon model. And we're plotting the value of certainty here across all 81 possible scenarios. Okay? And we can see one observation here is that when we plan using the deterministic naive model, we end up with value of certainty reaching up to 65% or even more, with a median of 20%, which is considerable. And this is basically telling us that the grid interconnection conditions are important when we plan. They're not to be neglected. That's the outcome of this first observation. Also, there is a huge drop in the value of certainty when we plan with a stochastic model. However, we can reach values for some scenarios that are pretty high also. If we adopt the receding horizon model, we're really at 0, practically. So it's basically as good as planning deterministically under a discount rate of discount on sold assets of 0. So it's pretty good planning under the receding horizon frame. Now we could vary this rate of discount and see what happens. And here we're only looking at the receding horizon case. We drop the stochastic and the deterministic. And with 0 discount, the value of certainty is practically 0. However, with higher discount, the median is still very, very low, but we can get values of certainty in increasing numbers. And this is kind of expected because at the end of the day, there is uncertainty. And when something happens and we need to adapt, we're selling the assets that we have, or we're replacing the assets. And when we replace the assets, if we don't get the full value, then we should be worse off than deterministic plan or certain plan. But it's not that bad. Also, to assess the impact of market liquidity on the problem, we can value the market liquidity itself. So if we plan with a 30% discount versus planning with 0% discount, how much did we lose because of the 30% discount? And the same for the 100% discount. And here we're plotting this for different prices of electricity that could be available when the grid becomes available. So we notice here that the value of market liquidity, the liquidity of the market is important when the price is low and is less important when the price is high. And the idea here is that when the price is low, you could prefer buying from the grid and getting rid of some of your own hybrid renewable energy assets, the system assets. When the price is higher, you could prefer using your system and ignoring the grid. So that's kind of the intuition here. But as we mentioned, this rolling horizon framework is very complicated, right? And it needs to be updated with all kinds of probabilities and scenarios. So the idea here is to try to simplify it. And one thing to consider before looking at these charts is that if the grid is available, let's say at year 4, your decisions at year 3, 2, 1 are the same as if the grid is available at year 5. Because in both cases, you're planning under uncertainty using the same stochastic models. And if you have the same belief system, you'll end up with the same results. So pre-grid, the receding horizon model is generating the same results, regardless of when the grid arrives, as long as you are pre-grid. So basically, you could approximate the pre-grid analysis by running a rolling model horizon, a receding horizon framework, where the grid never comes. Right? It's the same, because this means that all the years will be pre-grid in this case. That's one observation. And this is what we did here. So we're running the case of pre-grid installation for the case when T is infinity, so the grid never comes. But what's interesting is that if we run also a deterministic model, certain model, for the grid never coming, we end up with limited deviation between the two. So the deviation is 6%, somewhere like that. And here it's 5%. This is a discount rate, the rate of discount of 0. And this is a rate of discount of 100. So basically, rolling model horizon with T infinity will give us very similar results to a deterministic run with T infinity, pre-grid.
Rolling horizon is infinite horizon.
So you're planning under uncertainty, but what ends up materializing is a case where the grid never comes.
No, but I mean, rolling horizon has always been used with the understanding that I'm considering T period. So I do something, and next period I consider again T period. Whereas here you are always facing an infinite running horizon or wherever you are.
Actually, I'm calling it rolling. It's receding horizon. So the horizon is shrinking 1 year every time.
Ah, okay.
Maybe I used rolling. Okay, so this tells us that actually we could simplify all of this by 2 runs. By doing a deterministic run, assuming that the grid will never come, And then if the grid comes, update it once with another deterministic run, which is equivalent to here, with the grid information. And we call this decoupled planning. Okay? And to assess how good is this decoupled planning, we plot it. We plot the value of certainty for the receding horizon and the decoupled planning for different rates of discounts. And we can see that for low rates of discount, 0 and 30, they are almost the same. Even for higher rates of discount, the improvement of the receding horizon is negligible compared to the decoupled planning. So decoupled planning is performing pretty well, actually. And it's way simpler. It avoids all probability estimates. It avoids all scenarios. It's just deterministic. Plan for the worst, the grid will never happen, will never be there. And if the grid happens, plan, adjust accordingly. As simple as that. So these are the contributions from a framework perspective. We're basically developing this framework for planning. And we also account for the valuation of retired assets. And practical implications, we are saying that decoupled planning is very valid, especially in the context of Lebanon, the case study that we took. And increasing the liquidity of the market is always helpful. If we increase the liquidity of the market, we can overcome uncertainty, or we can limit the negative effects of uncertainty related to interconnection functions. So this kind of wraps my first discussion around hybrid renewable energy system planning. I will move to another one where we're looking at these private microgrids that are controlled by some powerful body, a private generator, and where the state has limited oversight over what happens there. Okay, so this is a status quo system in many countries like Lebanon, like Nigeria, like other places, where the grid is unreliable, unavailable, and then we have this private generator that is serving a community of households and other institutions. And this private generator controls access in the microgrid. So decides who gets this electricity and who doesn't, who has the line, the connection, the electric wire, and who doesn't have the electric wire. And also, the regulator, the state that is not able to provide electricity, tries to somehow control this by putting an upper bound on prices. But in a way that does not make this guy angry. Because if this guy is angry, he will stop. I don't care. And the state doesn't want him to stop, right? So what we're looking at is how can we make this nicer? Basically, we have households that own PV systems. And these households are only recipient of electricity or cut off from the microgrid completely. And they have curtailment in some parts of the day, definitely. So how can we benefit from this without messing up with the profitability of this guy? So we want a new system where this guy is incentivized to invest in renewable assets, not only diesel, and where we could benefit from whatever capacities are available at the household level. Okay, so the research question is, how can a regulator with limited regulatory oversight and who cannot challenge the profitability of the entrenched DGC is the diesel generator company, design policies that increase the utilization of household PV assets, reduce reliance on diesel generation, limit unmet demand, and improve electricity affordability. And all of these aspects are positive direction for this diesel-powered microgrid. So we looked into related work along these lines, and many of the existing work discuss, again, techno-economic analysis of these kinds of microgrids with optimal sizing frameworks and the use of various analytical tools. Also, some literature discusses feed-in tariffs, but at a national level and not at a microgrid level. So what we focus on, what we end up defining as our gaps, are basically that there is lack of microgrid level feed-in tariff policies in politico-economically challenged countries like the ones we're talking about, And the literature does not really consider market power at this level. And this is what we try to cover in this contribution. So just to provide an overview, we have a leader, which is a regulatory body. And this regulator is concerned with the utility of the household. So the leader wants to maximize the household economic surplus. And we have a diesel generator company that is concerned with maximizing profits. And the regulator has some weak regulatory power and can set upper bounds on prices. So an upper bound on the price of electricity sold in the microgrid. And we introduce a lower bound on the feed-in tariff for the electricity that is bought from households who own PV into the microgrid. Okay? However, this has to be done in a way that doesn't make the DGC unhappy. So the DGC has existing market power and political power, and we cannot infringe that. So the leader, the regulator, would want to design this policy in a way that preserves the economic incentives of the DGC. The DGC will then decide on who to connect to the microgrid and how to set the final prices and FIT. So mathematically, we're talking about a bi-level game where the leader is maximizing the household economic surplus. The leader is deciding on two things, a policy composed of two elements, the maximum price of electricity in the microgrid and the minimum feed-in tariff for household PV in the microgrid. And it has a coupling constraint where basically the leader wants the profits of the DGC to be at least the base profits to keep them happy. The DGC, as the follower, wants to maximize the profits subject to all kinds of economic and technical constraints related to the assets that he owns. And the household economic surplus of the leader is basically the discounted worth of the demand that is being met multiplied by the willingness to pay or the value of lost load minus the price, plus whatever is fed by the households in terms of electricity times the feed-in tariff. And the follower is maximizing the NPV, the net present value associated with the activity of the diesel generator. So the DGC has many decisions to make, but basically has some of them are one-time decision variables related to price and feed-in tariff. Some others are yearly related to capacity, and some others are hourly related to the operation of the existing assets. And we have all kinds of constraints. So to solve this problem, we're having a bi-level model with a lot of decision variables. So it cannot be solved analytically. And the way we deal with this is that we enumerate the possibilities of decisions by the regulator. So there are only two variables, so we can enumerate. And then for each enumeration, the regulator would solve the problem of the DGC, which is a mixed integer nonlinear program, to determine the actual price that ends up happening in the microgrid, the actual feed-in tariff and everything else. And if the resulting NPV is acceptable, so it's above the threshold, the base case, then we keep this solution. If not, we repeat. And we store the solution that generates the highest household economic surplus. And the solution that generates the household economic surplus will be the policy adopted by the regulator. Now we have problems because we have also here a mixed integer nonlinear program, which is not amazing to solve, especially with the number of variables that we have. So we look more into these nonlinearities, and the nonlinearities are due basically to the P variable and the FIT variable. So because the diesel generator is setting the price and the FIT, and at the same time deciding on how much to run the existing assets, there is a product of decision variables. However, we show that we can prove that the DGC will never pick a P and FIT different from the threshold set by the regulator. So we can show that it's best for the DGC to set P at P max and FIT at FIT min. And if this is the case, this means that P and FIT are no longer decision variables, they are input parameters, and we get rid of the nonlinearity in the model. Okay, we apply it again to a case from Lebanon, to a village in Lebanon, and we proceed with that. So to establish first a base case, we know the prevalent prices today in the market. They are around $0.4 per kilowatt hour. And to establish a consistent base of comparison, we wanted this existing microgrid, and we wanted to get the economics of the microgrid before our intervention, and then compare it with whatever we're doing. So we run the economics of the microgrid with a case where we have only diesel, and we don't have any feed-in, we don't have any renewable energy. We get a budget that is needed to run the microgrid, and we get a certain NPV 0 that we want to never go below it in our proposed system. And then we run our grid search over the higher level, the leader decisions, which are the price and the feed-in tariff, P max and FIT min. So we run a grid search over these, and we find which policies are feasible. So which policies satisfy the coupling constraint required, which is keeping the NPV of the diesel generator greater than or equal to the base case NPV. So this is what's at this line and below it. We're also looking at the cases here where we have feed-in. So it's optimal for the DGC to accept feed-in from households, and where it's not that much profitable. So the hatched area here is where feed-in is minimal, 5% of the demand satisfaction or less, and here where it's above 5%. And here we're looking at the objective function of the regulator, which is the household economic surplus, maximization of the household economic surplus. So for each valid solution here, we're looking at the household economic surplus, and we can identify which solution would maximize the household economic surplus. And it ends up being a solution where the price is 0.36 and the feed-in tariff is 0.12. And comparing the two, the status quo with the proposed model, we can note that the household economic surplus is way better with the proposed model. The wasted PV generation potential from the households that was curtailed was originally around 60%. And with the new model, we reduce it to 6%. We also noticed that the price of electricity dropped in the microgrid by 10%. We have feed-in at $0.12 per kilowatt hour. So this is gain to the households. And the renewable energy share in the microgrid increased from 0 to around 60%. And to further illustrate what's happening,
so what is the meaning of this unmet demand that has increased a lot?
Yes, I will discuss this point. So here, in the status quo, we had around 2% of unmet demand. In our system, we're ending up with more unmet demand. And this is due to the utilization of, even by the DGC himself, more renewable energy. So he's installing PV and batteries, not only diesel. And this means that sometimes the DGC prefers to not deliver electricity rather than investing in extra capacity. But I will discuss this issue, and this is problematic, definitely. And I will discuss it in a bit. So these are the decisions that the DGC is making in the first chart to the left. So here we have DGC, only diesel, and then the existing capacity retires at year 3, and then invests mostly in PV and batteries and some diesel capacity. If we look at the energy generation profile, the light gray area here is the feed-in. And you can see that the feed-in is constituting more than 30% of the generation. So that's a big role that is being played by the feed-in from the household PV. Additionally, we have a lot of renewable energy picking up from the diesel generator himself, the diesel generator company itself. Okay. So we did some sensitivities, and to answer your question, George, here we're starting with a budget that was determined based on the status quo. So this is the budget needed to run the status quo model. So we used it in the proposed model so that to be comparable. Now, what we're doing here is we're running a sensitivity on the budget, because the budget is a main element of concern in developing countries when we talk about electricity systems. So here we're varying the budget from 420K up to 1.75 million. And we're seeing the effect of this variation on the feasible policies. We're starting here. This is the lowest budget of 0.25 million. And the green is the highest budget with 1.75 million. So we can see with increasing budget, the feasible policies are higher, there are more possibilities. However, the policies where there is considerable feed-in, so the not hatched area, is getting smaller. Because with higher budgets, the DGC ends up preferring investing in its own renewable energy capacity rather than feeding in some cases, when the feed-in tariff is high enough. That's why the hatched area is increasing. So in terms of household economic surplus, with higher budgets, we are expecting to get a higher household economic surplus that increases. So this increases until basically reaching around 1.25 million, where it plateaus. And basically this budget becomes no longer binding for the DGC. We also look here at what ends up being installed in each case of budgets. With higher budgets, the DGC gets rid of diesel and installs only PV and batteries, no longer diesel. Also, if we look at the energy generation portfolio, we notice that with higher budgets, we're again getting rid of diesel. We're relying more on solar. The feed-in is almost constant throughout, with a little bit of variation. We also look at varying the share of PV owners in the microgrid. So we're starting with a share of 40%, the default case, which was the actual case that we worked with. So what happens when we vary this share? When we vary it between 0 and 100%. So with higher shares of PV owners in the microgrid, the diesel generator company will stop relying on diesel, but will also stop relying on PV. And will only install batteries. Because, I mean, there is enough generation from all the PV owners. So just act as a battery and organize and shift temporarily the available supply. Okay, so to wrap up this other perspective, what we formulated is a bi-level game theoretical model representing a regulator with limited oversight at the first level and a monopolizing diesel generator company at the second level. What we showed that basically we have achieved improvements, except with one thing related to unmet demand, across various dimensions. So if we look at the utilization of PV owners' assets, in the status quo, we're wasting 60% of their generation potential. With the proposed model, this drops to 6%. With some budget sensitivities, we can even drop it further. And some PV owners sensitive. So if we increase the PV owners or reduce the PV owners in the microgrid, we could also eliminate completely this wasted surplus. In terms of reliance on diesel generation, we start with complete reliance on diesel generation or zero reliance on renewable energy. And with the proposed model, we increase the reliance on renewable energy to 60%. And we can reach up to 100% with some higher budgets and higher PV owner shares in the microgrid. For unmet demand, we're starting with 2%. Our proposed model results in 12%. However, if we allow for higher budgets, we can drop further this number to 4%. Now, this is a limitation of being only able to regulate P and FIT. If you are a stronger regulator, then you could achieve better results here. But this is the limitation of the current weak regulatory framework. And in terms of affordability, the proposed model decreases prices by 10%, and if enough budgets are available, we can increase it further to 30%. So maybe very quickly, just to give you pointers about a third perspective, where we're looking at a state that wants to design its national electricity plan. And while households are, some of them own PVs and some of them don't own PVs, and the state is suffering from shortage. So it doesn't have enough generation capacity. So I will just discuss how we formulated the problem and maybe one or two key takeaways from that. So the state wants to design this national electricity plan under generation shortage. So basically what the state would like to decide on, how much to invest in new capacity, how much to invest in network upgrades to allow feed-in into the network, how much to use from the old generation that is inefficient, and how to price feed-in into the national grid. What is the feed-in tariff? So these are the kind of decisions that the national utility wants to make. And at the same time, we note that in these kinds of countries, we're talking about a national utility that is supposed to provide services to the citizens. So it is selling electricity at cost, and it's not making profits. So the utility will decide on these things, but we have other players who are the receiving end of these decisions, who could also be active players. So we're looking at 4 categories of households: those who own and those who don't own PV, and those who are connected to this microgrid of diesel generator, and those who are not. Okay, so 4 possible kinds of households. And these households could react to the decisions of the state by joining the FIT program or not joining it. So it's a binary decision for each one of them. So this is a more elaborate description of what I said. We're starting with an electric utility that wants to minimize the total annual cost and is making decisions along investments in generation assets, investments in grid upgrades, feed-in tariff, and how much to use from the existing generation assets, the old ones. The price of electricity is a formula reflecting all the costs of generating electricity. And then the followers are 4 players who are playing a game also, because they affect each other. So what other players do affect them also. So there are a lower level game happening, an equilibrium game that is happening between these players. The problem is analytically complex, and also we tried with Maririta, who is also attending today, to solve it analytically, but it's not solvable analytically. So we benefited from the fact that the decisions at the lower level are binary and are countable. So we have 4 players with 4 binary decisions, so we can iterate over them. Now, I will not go through the details of how we solved this, but we solved this, and we can discuss this outside if you are more interested. And here I'm just showing some results. So what happens to the decisions of the electric utility and the households when the budget available to the state is varied? So the base case is a budget of infinity, so there is no limit on the budget. And here are different budget cases that limit the possibilities of investment from a state point of view in new capacity or new network upgrades. And here is a scenario where somehow politically we are required to run the old capacity first before investing in any new capacity. And we can notice here that in all cases, the state prefers investing in network expansion first, then in new capacity of generation. Because when the state invests in network expansion, it can accommodate feed-in from households. And when it accommodates feed-in, it ends up being more economically attractive than investing in own generation. In terms of households, they generally contribute to the feed-in tariff program. So those who own PV join the program because they own PV, and those who do not own PV, they have to install PV to join the feed-in tariff program. However, it seems that all of them prefer joining the program as long as the budget is high enough. At low budget, one category of households does not prefer to join the FIT program. And one final thought in terms of electricity mix under different budgets, with an infinite budget, we end up with feed-in, self-consumption, a lot of self-consumption by the PV owners, and new utility here. With lower budgets, we have diesel generators filling the gap and some shortages. So key takeaways from what I discussed today. Under HREF planning, the recommendation is to plan as if there is no reliable grid and adjust accordingly. When we talk about weakly regulated microgrids, some soft regulatory interventions could improve considerably affordability and asset utilization. And at a national level, the priority is to accommodate feed-in and improve the network before even investing in new capacity. So these are the references, and I'm happy to answer your questions.
Thank you very much, Majd.